All right. Hey guys, welcome back to the Dude Real Estate Show. I'm here with Billy once again. Billy, how's it going, man?
Good. It's 2021. Hard to believe we're here.
Oh, thank goodness. We made it. We made it. So today we're going to tackle a topic I think that might have some interest to a lot of people. We're going to talk about real estate investing in expensive markets, or what are your options if you are in an expensive real estate market? What can you do? Do you have to invest there? Maybe it's a little slower, or do you have to go somewhere else where it's cheaper? So I think this is relevant because we actually talked about this in one of our uh, earliest episodes where, the Madison market is kind of what I would consider a little more expensive market, especially based on, um, just some of the outlying regions here. There's only
Mhm.
a couple other markets in Wisconsin that might be a little more expensive, and those are more resort areas, stuff like that. So
Mhm.
the challenge with investing in expensive markets is that they're expensive. And so it's going to
Mhm.
require more capital. Now, that doesn't necessarily have to be your capital, but I think the perception is for a lot of people that, well, boy, if it's going to take $500,000 for me to get started, how is that ever going to happen? I'm going to need 100 grand just to have as a down payment, and then I have to have reserves on top of that. And what if it needs work? What if I have a vacancy? All sorts of stuff. So I think what people end up doing if they are in an expensive market, they either delay or don't even get into real estate investing at all, just because they think there's too big of a barrier to entry. But what some people do is they're like, well, I do want to invest. I guess my only other option is to go somewhere cheaper. So I know they talk about this a lot on Bigger Pockets about within an hour or two drive of where you live, pretty much anywhere in the U.S., you are able to find a spot that has more affordable properties. But I think the question you have to ask yourself is that still a good strategy? I think what people are looking for, especially initially, is they want those two magic words. They want cash flow.
Mhm.
And so that's why they're looking at typically cheaper properties that are going to cash flow more for them,
Yeah.
which at the beginning is not necessarily the worst thing to do. It might be a good idea to start with cash flow, and then you move into some other areas where maybe you're getting more appreciation, or you're investing in more like A and B properties in really good markets. And so maybe you just get your feet wet with some of this other stuff first, with some cash flow, cheaper properties, and then move on to something else. But I think the bigger question is, why is a market expensive in the first place? And I think it's kind of intuitive, but we don't really talk about it, is that it's just because of location, right? Location, location, location is the
Mhm.
real estate mantra. So if a location is expensive, it's not a bad thing. It's actually a good thing. It means that people and businesses want to be there. Um, so that kind of makes your job actually a little bit easier as a real estate investor. You don't have to really take a deep dive into the demographics of an area necessarily. You can just kind of look at home prices. And as long as it's not a bubble, sometimes on the coast, like if you're in New York or San Francisco, those can get kind of bubbly at times. But if you're looking at like other expensive markets, like maybe, Nashville's getting a little expensive, and maybe Dallas Fort Worth is getting a little expensive.
Mhm.
Phoenix area could be getting a little expensive. That can also be a little bit of a bubble too. But if you look at these markets, it's just an indicator that people want to live there, people want to do business there. And so everything else kind of follows after that. If you're going just for cash flow, you have to ask yourself, well, why is the cash on cash return so high on this deal? It's probably because there are a few things that you're taking a risk on. One
Mhm.
might be there might only be one or two decent sized industries in town. And if one of those goes away, there might be a lack of jobs and a lack of income, and people
Mhm.
might move away or just not be able to pay if you own properties there.
Mhm.
One of the other risks could just be the fact that it's a cheaper property in an area that's maybe not growing, maybe it's stagnant, maybe it's slightly declining. What are home prices going to do there? What are home values going to do there? They also might be a little tougher to manage. So if you do have to go an hour or two outside of your, your comfort zone or where you live, how easy is it going to be to manage that property? How well are you going to be able to get to know that market? And my argument has always been, if you're willing to go an hour or two away, you might as well go 12 hours away. Find a different market that might have cash flow, that actually has like a growth economy, or better landlord tenant rules, stuff like that. So that's a bunch of words I just threw your way. Do you have any thoughts on this so far?
I think the question for me is like, it's hard to identify. Like, it's easier once it's already happened. Like, oh, this market was growing and, I missed it. Like everyone's always looking for the next Amazon stock or Bitcoin or something like that. So my question would be, how do you figure out that if that market's already saturated or if you're still in like the growing stages of it?
Yeah, that's a really good question. It's a super tough one to answer. I don't know if I have a good answer for that. It's like you say, like Amazon, like Bitcoin, it's like everyone's like shooting themselves like, why did I not jump on that a year ago? Because of what it's done. But we can't really tell the future. But if you look back, you can look back at some of these markets. Like I said, like New York, San Francisco, a lot of times they're basically bubble market cycles. Same thing with Phoenix. It's like in Las Vegas, they go on these huge runs, which is awesome if you can ride it up, but then there's these huge busts too. So I guess what I'm trying to get at is that you can look at other markets though that maybe don't have as much of a run up and as much of a deflation afterward. It's just something that's a little more stable. So you might look at more like a Dallas Fort Worth or something like that, where fairly stable economy, good growth metrics, stuff like that. Whereas like Houston, another boom bust because of the oil business down there. So I think if you just kind of look at something that's fairly steady, like you look where we live in Madison, it's just fairly steady. Like it's just, you have a lot of good economic indicators that say that people are probably going to continue to want to work here and do business here for a lot of different reasons. And that's going to continue to push prices up. Now, there are other factors that could lead to declines. I mean, a lot of people are in default, but you'd have to look where a lot of people are in default. This might not be necessarily in the town you want to invest in. So there will be opportunity this year and next for sure, because a lot of people are in default, but you got to find where those are. Certainly every part of the US will have some sort of transition period where these homes that are going to go into foreclosure, most likely there will be opportunity for investors. It's just a matter of what's the volume going to look like? Is it going to be more or less in your particular area?
And you feel like that'll probably be in these bubble markets more than like a consistent Madison market?
I think so. That tends to be what happens. Like if you look at the last recession, you saw in like Las Vegas, like home prices got obliterated. And then there's a lot of good deals on the table for investors to pick up, between say 2010 and 2016, something like that, where they could buy stuff for pennies on the dollar, and then they were able to ride that wave back up, whether they're flipping or renting or whatever. So the one other thing I was going to mention about expensive markets is it's typically they're going to grow, they're going to have more appreciation. So like if you're in a rural market, those are going to stay kind of flat. They're still going to go up over time, but relatively flat. But if you look at these growth cities, these growth areas, they're going to have a better appreciation. And the nice thing about that is not only do you get the appreciation, but because it's a more expensive property, it kind of gets even bigger because of that. 5% appreciation on $100,000 property isn't as cool as 7% appreciation on a $500,000 property.
Exactly.
So you can, and I hate to speculate on appreciation, but you're going to have a better chance at getting appreciation if you're in a market that has more of a potential for growth.
Mm-hmm. Agreed. So to put you in my shoes where I am trying to start out, do you think it's more valuable to try to get in a growth market with good appreciation, or to go somewhere a little bit further out, potentially from the city, that you can get it for a lower price, and maybe get a little more cash flow, but you're not going to see that I guess growth in home values?
Right. I guess it depends on a couple of things. It depends on your goals,
Mm-hmm.
and it depends on your strategies.
Yeah.
So if your goal is you just need that cash flow, I think it's
Mm-hmm.
fine to go to a cash flow market. I think that's a decent way to go about it. If your goal is just, even just to get started and it's just more comfortable for you, go for that first place that's maybe a little cheaper, where you're taking a little bit of financial risk off the table, but maybe you're capping your upside a little bit there. But you get your experience, you probably make some money,
Mm-hmm.
and you get started, which is really important. And I think that's the way most investors start. Most investors don't start with like, a $2 million apartment building. They get their feet wet with something else. And so yeah, it depends on if you want that immediate cash flow, or maybe you go with something that has a little more growth potential, and maybe you don't make as much money right out of the gate, but you have a little more future wealth building potential there. And then your strategy matters too. So if you're the only one that's buying the property, it matters like how much money you have, how much of your money are you going to put on the table, or are you going to partner with somebody? Are you going to go the creative route and use like low and no money down type of financing, maybe use hard money, things like that. So it does depend on your strategy too.
Mm-hmm. Okay. Makes sense. Yeah. I think it's again, it always goes back to, like you said, location. And then if you're willing to take a little bit more of a risk for higher cash flow, you can look at those, suburbs or smaller markets that are, leaning on one business industry or something like that. And there's risk with that, but at the same time, like, make sure that it's still a good location, probably a good property. And those are the things that are going to keep you in a good position.
Yeah. Yeah. And I think you can go somewhere in the middle too. It doesn't have to be necessarily so far out. It could be, a suburb or a suburb of a suburb, or maybe it's, if you look at kind of a path of progress type of play, like, between Madison and Milwaukee, is there a market that, is kind of somewhere in the middle that's a little bit cheaper, but is close enough to both markets that it benefits? There's a lot of travel back and forth. People can commute to either city pretty easily, and Chicago too. So that could be an interesting way to look at it. Maybe you pay slightly more than you would in, say, like parts of Milwaukee or somewhere that's more rural. But you have that safety net of having bigger things and infrastructure around you.
Yeah. I like that. That's a really good idea. I think for me is to focus, like, it doesn't have to be in Madison or Milwaukee or Chicago. Like, you can definitely look at places that position themselves in a good distance from those markets that are going to need, rental units for people to commute, in a place to live. So it's definitely a good opportunity. Yeah.
And I think now more than ever, people are willing to open themselves up to living outside of cities, and they're looking for more rural or suburban properties, because of what COVID's done. It's kind of fragmented how people work. And if you're any type of white collar work, you're working from home a lot of the time.
Mhm.
And I think businesses are probably going to realize that it's probably more viable for them. I mean, they're
Yeah, save
not
some money.
paying, yeah, they're not paying as much money for office space. It's probably a coin toss whether or not people are actually more productive. I mean, maybe you could speak to that. Do you feel more productive at home or or when you go to an office? But it's
Yeah.
it's an interesting thing that's happening right now, and we're kind of seeing a small exodus from some cities
Mhm.
to um, suburban or rural areas. So I think that'll be a trend for a little bit, but I think eventually you see these cycles where people do come back to the cities.
Yeah, agreed.
So cool, man. I think that will wrap it up for this one. Thanks for watching, guys, and we'll see you in the next one.